Something happened this week that I need you to understand before you make any decision about your portfolio. $6 trillion disappeared in 48 hours. The S&P 500 fell 10%. The VIX spiked to 45, levels we haven't seen since March 2020. Oil collapsed, copper collapsed, and gold, the asset every central bank has been accumulating for exactly this chaos, also fell. Everything went down simultaneously during a trade war that should be inflationary. Here is the question I want you to hold. If tariffs cause inflation, and inflation historically supports hard assets, why did everything collapse together? Why did the assets designed to protect you fail? The answer is not what financial television is telling you. And understanding it will change how you read every market move for the rest of this decade. I have spent 40 years studying economic systems. The patterns that repeat because human nature does not change. Debt cycles do not change. And the mechanical relationship between policy and asset prices does not change. What I am watching is not new. The trigger is new. The transmission chain is 50 years old. Subscribe now. Let me start with what happened. On April 2nd, the United States announced a universal tariff, 10% baseline on all imports, with higher rates on approximately 90 nations. The market sold off immediately. China announced 34% retaliation. Within 2 sessions, the numbers I described became reality. The conventional explanation is markets don't like uncertainty. Tariffs create uncertainty. Therefore, sell off. That is not wrong, but not useful. It describes the surface, not the mechanism. Without the mechanism, you cannot know how deep this goes or what to do. So let me give you the mechanism. A tariff is a tax. When a government imposes a tariff on imported goods, someone has to pay it. The question of who pays is the most important economic question in this entire situation. The common assumption is foreign exporters absorb the tariff. The Chinese manufacturer accepts a lower price to maintain market access. The data from every major tariff episode in recent history shows this is not what happens. Analysis from the Congressional Budget Office and multiple Federal Reserve regional banks consistently finds that foreign exporters absorb between 4 and 10% of the tariff cost. The remaining 90 to 96% is passed to American importers and from there to American consumers through higher prices. This means the tariff functions as a broad-based consumption tax on the American economy. Every dollar collected is a dollar extracted from disposable income and corporate margins. Consumer spending falls. Corporate earnings expectations fall. And since the stock market is a claim on future corporate earnings, when earnings expectations fall, stock prices follow. This is not fear. This is arithmetic. Here is where it gets dangerous. Tariffs are inflationary. When import costs rise across the economy, the broad price level rises. Powell said this explicitly at recent FOMC meetings. The Fed's inflation forecast was revised upward, GDP growth downward. The central bank is watching prices rise and growth slow simultaneously. This is stagflation. And stagflation is where the Fed's primary tool becomes impotent. Think about the bind this creates. If the Fed cuts rates to stimulate a slowing economy, it risks making inflation worse. If it raises rates to control inflation, it accelerates the slowdown. The Fed cannot move in either direction without making one half of the problem significantly worse. So it does what it has been doing. It holds, it waits. It says uncertainty is remarkably high and does nothing. Here is what most people miss. For 15 years, markets operated under one assumption. Whenever a significant decline occurred, the Fed would intervene, cut rates, expand its balance sheet, inject liquidity. This happened so reliably traders called it the Fed put. Buy the dip because the Fed will step in. That assumption is now in question. Not because the Fed doesn't want to help, but because tariffs remove the policy space needed for traditional intervention. When inflation is above target and tariffs push it higher, cutting rates is not viable. The insurance policy markets priced for 15 years has become conditional. When markets realize the insurance may not pay out, repricing is abrupt. That is what we saw this week. But there is another layer explaining why gold fell with everything else. Over 2 years, as gold climbed from $2,000 to its January high of $5,595, approximately $70 billion flowed into gold ETPs. A significant portion went into leveraged products offering 2 or 3 times daily returns. These require daily rebalancing. When gold falls, the leveraged product must sell futures to maintain ratios. That selling causes further decline. The decline triggers margin calls. Those calls force liquidation of everything liquid. This is forced selling, completely indifferent to fundamental value. When a fund gets margin called, it does not ask if gold is undervalued. It sells at whatever price, because it has no choice. This mechanical cascade, leverage accumulation on the way up, forced liquidation on the way down, is why everything fell simultaneously. It was not a judgment that gold was overvalued. It was a liquidity event, a fire sale driven by leverage mathematics, not by assessment of intrinsic worth. Here is the historical parallel. In 1929, the U.S. economy operated at elevated valuations. The Smoot-Hawley Tariff Act was passed in 1930, raising import duties to historic levels. Partners retaliated immediately. Global trade volumes fell 65% between 1929 and 1934. Corporate earnings collapsed. Unemployment hit 25%. A financial crisis became a generational depression, amplified by the very trade policy supposed to contain it. I am not predicting a repeat, but the mechanism is identical. Tariffs raise costs, partners retaliate, demand contracts, earnings fall. The Fed's room narrows. The economy enters stagnation, harder to escape because inflation prevents the aggressive monetary accommodation that typically ends recessions. There is a more immediate parallel. Last year, when the first round of sweeping tariffs was announced, the S&P 500 lost approximately 10% in 2 sessions, almost identical to this week. The administration paused some tariffs, offered exemptions, and the market partially recovered. Some traders interpreted this as confirmation that the administration always backs down before pain becomes severe. That pattern may be correct or may not be. The problem with building a strategy around predicting a single decision-maker's pain threshold is you are not analyzing economics. You are predicting psychology, and psychology is considerably less reliable than mechanism. Focus on what structural forces are doing. Tariffs are inflationary. The Fed is constrained. Corporate earnings are under compression. Leverage is unwinding. Global trade is contracting. These forces do not change based on tweets or press conferences. Let me turn to second and third order effects over the next 12 to 18 months. First, supply chain repricing. Global supply chains were built over decades around specific tariff assumptions. Those assumptions are now disrupted. Companies cannot restructure in weeks. During transition, input costs stay elevated. Production efficiency falls. The inflation tariffs create does not dissipate quickly because supply chain disruption compounds the direct price effect. The Fed's constraint could persist 2 to 3 years. Second, the dollar. Near term, during acute stress, capital flows into treasuries as the most liquid safe haven. This supports the dollar short term. But medium term, when the U.S. imposes sweeping tariffs unilaterally and uses market instability as a negotiating tool, it signals American policy is less predictable. Predictability is the foundation of reserve currency status. When that reliability is questioned, the dollar's reserve premium erodes gradually in ways that compound over years. Third, the most relevant effect. When governments pursue policies that suppress growth and sustain inflation simultaneously, the historical response is consistent. Eventually, the monetary authority prints money because prolonged stagnation is politically unsustainable. Timing is uncertain. The directional consequence is not. More money in the system, lower real returns on financial assets, higher nominal prices for everything that cannot be printed. Gold, real assets, hard commodities. This is the critical distinction between what is happening to gold right now, a mechanical liquidity event driven by forced selling, and what structural forces are pointing toward for gold over the medium term. The forced selling is temporary by definition. It ends when leverage clears. The structural case for gold, fiscal excess, monetary accommodation, dollar erosion, central bank diversification is not temporary. It is the product of decades of debt accumulation and policy choices that cannot be reversed quickly or painlessly. Let me be specific about what this means. First, understand the difference between an asset falling because fundamental value changed versus falling because leveraged participants are forced out. A house worth $500,000 is still worth $500,000 when the seller urgently accepts $400,000. Price changed, value did not. Watch whether fundamental conditions determining long-term value changed. For gold, for hard assets, those conditions have not improved. They have deteriorated structurally. Second, watch the Fed's next fundamental shift. When the Fed is forced to pivot, when unemployment or contracting growth creates political pressure that outweighs inflation concerns, all three headwinds suppressing gold reverse simultaneously. The dollar weakens, real yields fall, liquidity returns. Historically, these reversals are fast and significant. Investors positioned before the pivot capture the bulk of the move. Those waiting for confirmation enter after most recovery occurred. Third, and most important, the worst decisions are made at moments of maximum apparent clarity, when the narrative is so dominant that departing from it feels irresponsible. Right now, the narrative is markets are collapsing, trade wars are uncontrollable, recession is inevitable. That narrative has enough truth to feel credible, but is incomplete. It describes the current phase as if it were terminal. It is not. The debt cycle does not end with a trade war sell-off. The structural forces driving monetary expansion and the long-term case for hard assets are not resolved by 2 bad weeks. They are accelerated by them. The system is under stress. Stress is not chaos. It is how overvalued assets find real price, over-leveraged positions clear, and the structural bid for scarce assets reasserts itself. I have watched multiple cycles. The pattern is not new. The transmission chain from policy disruption to market stress to eventual monetary accommodation to hard asset outperformance has repeated across different historical circumstances. What changes is the trigger and timeline. What does not change is how debt cycles resolve, how fiat currencies behave under fiscal stress, and how markets reprice when assumptions are questioned. Pay attention to the mechanism. Headlines change tomorrow. The mechanism will not.